I am pleased to welcome you to this webinar, which looks at the South African debt capital markets and the effects that the crisis has had. My name is Monwa Zugani. I head up the legal teams responsible for FIC, master agreements, and Africa regions within Global Markets Legal and Standard Bank. And I'm also the chair of the ICMA Africa Regional Committee, which provides input to ICMA on how the association can best serve its members and the wider market on the continent. ICMA has been active in the continent for many years, with our first members joining from South Africa in the early 2000s, and we are seeing our membership grow from other countries such as Ghana, Nigeria, Cote d'Ivoire, as more and more African institutions start accessing the cross-border capital markets. ICMA has also been working on capacity building through its education program on bond and repo markets in cooperation with the development agency Frontier for local central banks and market participants across many countries throughout Africa. We hope you enjoy this first in a series of podcasts and webinars which aims to highlight the African capital markets to the ICMA community. I will now hand over to Katie, Bruce, and Robin.
Hello, everybody, and welcome to this webinar. So I'm delighted to be joined today by, first of all, by Bruce Stewart, who is the head of debt capital markets at Nedbank, and by Robin McLennan, who is the head of credit research at Standard Bank. So moving on to the substance of our webinar today, I think it's probably quite useful if we start with a snapshot view of the economy in South Africa. So Bruce, I'm going to start with you, and I wonder if you could give us a quick canter through the COVID-19 journey in South Africa, how it has evolved over the past couple of months, maybe by reference to the state of the economy before the pandemic and since.
Great, thank you. To answer and respond, I've basically put out a bit of a timeline of events, just understanding how things have impacted on our local debt capital markets. And to that effect, you'll see up on the screen in front of me, I've taken a snapshot of what the JSE's behaviors look like and what the S&P 500's done, and see how closely correlated we are to global events. But essentially, at the end of February, it was looking like it was going to be a fantastic year for our debt capital markets. We'd issued up to about 170 odd billion of rand in the local DCM in 2019, and we were looking for an equally stellar performance in 2020. Suffice to say that the first 3 months or 2.5 months, we were on track for that sort of issuance, probably on average about 15 billion rand a month. And subsequently, as you can see on that top graph there, the indices just have fallen off the edge of a cliff, and our issuance went down to sub 1 billion from 15 billion per month. So it does give you a bit of a feel just in terms of when that global volatility began towards the kind of middle end of Feb. Equity markets took a global turn. I think equity markets were pretty fragile to start with anyway, even before COVID arrived. And so it was probably the final straw that broke the camel's back. The South African equities and bonds just followed suit in terms of their risk-off sentiment. And we saw the rand depreciate significantly to over 19. And a lot of impact on the domestic capital markets felt because but foreigners hold a substantial proportion of domestic rand-denominated South African government bonds. And of course, it was a flight to safety, and that got sold off, and that obviously weakened the rand as well. And it would have implications for the domestic corporate bond market down the track. And we'll talk a bit more about that in a moment. But essentially, just to plot the trend over the last sort of 6 months, you could see the big fall in March, and then the slow recovery, but certainly not back to where we've been. And I think whilst the JSE Aussie follows the S&P 500 and global markets quite closely, the domestic debt capital markets certainly haven't recovered to the extent that those graphics would indicate. Also moving into March, we had our own issues. We had our we introduced a state of disaster and introduced travel restrictions and closed schools in the middle of March. We also had Moody's downgrade South Africa. We also had our budget speech. So significant domestic events, both political and otherwise, that contributed to that. And looking at that bottom graph gives you a good feel. We plotted basically the foreign flows, which is the outflow of government bonds or capital out of the country. And you can see it's significant. That dark green line has just absolutely plummeted as capital flows exited this country. And we saw that overhang pretty much last until the end of April, when there was a balancing of the kind of WIGB passive indices. But by and large, that's out the way now. And we would anticipate that down the line, there would be some attractive yields to be sought in a very low yield global environment. So possibly towards the end of the year and going into next year, you could see some capital inflows, positive capital inflows returning, which would be a mighty useful boost to everything debt capital markets or fixed income related or capital related in South Africa. So that's just to give you a snapshot of what actually happened. Now, the impact of that, and this is just continuing from that, the impact of the foreign flows are significantly worse than the last 2 years. And you can just see by the top graphics there, just what 2020 has meant relative to the other years. Of course, everything came to a grinding halt. We had to cancel auctions. The debt capital markets, for all intents and purposes, came to a standstill as liquidity dried up completely. And when I say dried up completely, we have the benefit in this country of having a substantial institutional investor universe with quite broad and deep liquid pockets, sufficient to fund domestic requirements by and large across banks, financial institutions, and corporates. However, when the risk off is risk off, it's properly risk off, and to that extent, all the taps ran dry, and investors just were targeting liquidity first and foremost above everything else. So those that wanted to refi in our debt capital markets have been unable to, particularly in March and April. And we'll talk more about it, slight sort of green shoots happening in June, but we are by no means, how can one say, ready to engage and open up. And what we've seen is tentative private placements as opposed to even significant book builds, let alone having a public auction, which is completely off the cards at the moment. I mean, our domestic investors have focused on liquidity. If there's anything that's going to be issued in our market, it's going to be short term. The volumes are going to be smaller. And of course, benchmark pricing has just absolutely vanished. And so your traditional benchmarks, and I think Robin will allude to it a bit later, have been super volatile. So volatility in the bond market has only been exacerbated by the liquidity shortfalls, and of course the nervousness that gets created by the lack of capital as it flows offshore. And we've seen just the spreads move out significantly, and we can do some more analysis on the spreads. But just in general, we've seen spreads move north of 100 basis points, approximately, depending what kind of credit you're looking at. And that sets a very sort of glum tone for March, April, May, from what was going to be a very sort of, how can one say, exciting prospective 2020. I hope that gives you some sort of feel for just the setup as we go into the discussion around how COVID's impacted our debt capital markets.
Sure. And we will touch upon some of those themes, as you say, later on. Robin, did you have anything to add about just generally the state of the economy and how, in general terms, COVID-19 has had an impact?
Yes, so we were already expecting 2020 to be a fairly challenging year. South Africa is in a very low growth environment at the moment. So before COVID hit, we were expecting GDP growth of just 0.8% this year. Our National Treasury now expects GDP to contract by 7.2% this year. Our economist is even more bearish than that, expecting growth of minus 8.5%. And our recovery is likely to be slow. National Treasury is penciling in growth of just 2.6% next year. and 1.5% in 2020. So that it will be a protracted recovery. And unemployment is a huge problem in South Africa at the moment. So our official unemployment rate rose to 30.1% into one of this year, on an expanded base, including those who've been up looking for work, that's 39.7%. And this is likely to rise further due to subsequent job losses from the various stages of lockdown that we've seen in South Africa.
That's pretty significant figures that you're giving us there. And it might be helpful also at this stage, I guess, if you could give us an indication, and we're speaking today as at the 29th of June, but if you could give us a bit of an indication as to where you think lockdown is and possibly the ease of lockdown is heading in South Africa vis-a-vis the rest of the world, where restrictions are starting to lift. You know, they're talking about people going back to work and kids going back to school, etc. So I think we're hoping that by September this year, there's going to be a significant shift and change in the economy. Where is South Africa in that respect? Robin, could I start with you?
Sure. So we're currently in what they call level 3 lockdown. So that compares to a level 5 complete lockdown that we had in April, and starting at the end of March and into April and beginning of May. That was when the economy was completely closed and only essential services were allowed. So we're now in a level 3, and they've recently amended some regulations, so they've called it enhanced level 3. Where much of the economy is starting to open again. They are phasing back in the schools. So we've seen a couple of grades returning already. We are now looking at reopening restaurants and beauty salons, etc., under strict conditions. Most retailers are open again. And so much of the economy is getting back to work. And I think this has been in recognition of the economic hardship, that many parts of the country have faced during the more severe lockdowns that we had.
Bruce, what are your views on that?
Very, very challenging times indeed. Make no mistake. Our thinking is, as Ron said, we'll only peak in August, maybe September at best. And we still don't understand then, because we are only expecting the peak come, what the economic impact, what the long-lasting economic impact might be on credit in South Africa. And of course, like one of the asset managers, one of the larger asset managers has reiterated time and time again, there's plenty of liquidity in South Africa, but it's not going to be applied and it's not going to follow a deteriorating credit. And the question is, are you a deteriorating credit or not? And most people don't really know. So when you don't know, it's a risk-off situation. And I think the round 2 that we are going to, well, we're still into round 1, but I get a sense that the global COVID world is going to go into round 2, and there could be some significant impacts that come out of that. So, we've seen a nice bounce in global equity markets, lots of QE, lots of liquidity, lots of keeping zombie companies alive. I still think that the jury's out in South Africa with respect to COVID and its impact from an economic point of view. And that makes investors nervous. And so I would suggest that those credits that are stable and are benefiting from this environment will certainly be supported, but there are those that won't. And to add to that, that's an external sort of factor. We have our own challenges just from a political fiscal point of view domestically to manage at the same time, and we haven't had kind of like positive tailwinds. In fact, we've had some headwinds in the form of SAA and Land Bank, and these are state-owned entities that have had to either go into business rescue or be restructured, and equally, and that it once again just puts a question mark and uncertainty over the institutional sort of framework of investors in South Africa, and they would stand back and they would say, listen, my best bet is to go for and invest in government bonds, because that's where some of the best yields are relative to corporate South Africa or municipalities or state-owned entities. And I think the attractiveness of fixed rates has certainly maybe created an opportunity for them to invest in some sort of yield return as opposed to the floating rate environment, because we've had our domestic interest rates drop by over 2%. And on balance, we've seen credit spreads widen maybe 100 basis points on average, certainly more in the higher, the weaker credit cases. But I mean, even if it's 150 basis points up in credit spread, a 200 basis point fall in your base rate, investors are pushed to get where they're going to find more than a 6% return in this market, with our JIBAR rate being at 4%. And so I think that's just another one of the reasons why if they're going to participate in this market, it's going to be support of government auctions. And we've seen that happen as they've picked up the reins from global investors who are divesting. I think the domestic market certainly been supportive of the South African government bonds.
Very good. Thank you both for that. Very interesting insights. Now, just doing a bit of a deeper dive into some of the more the primary and the secondary markets. So, Bruce, we've talked a little bit about the effect that COVID-19 has had on, well, funding programs, issuance volumes, etc. But I mean, can you give us a wee bit more detail on ease of access to the primary markets, the operations and transaction execution? Is that affecting issuance patterns? Are deals struggling to get over the line? And what has COVID-19 meant for primary spreads?
Okay, yeah, there's a whole bundle of stuff there to share with you, Katie. So let's just take it one at a time. I'll share a slide or two with you. Just looking at our markets historically, you could see the trends there in terms of which sectors have been sort of prolific issuers. I don't want to spend too much time on this space, but what we've seen when this risk off arrives is that liquidity is first and foremost the concern of everyone. I mean, there were institutional investors, to give you a story, that had repurchase books where they repo the South African government bonds out on a weekly basis. And the margin calls just for one investor was to find 400 million Rand in 24 hours. So, I mean, if you don't have that kind of liquidity, you start selling your better credit into a market that's not essentially open. So you've got to sell your best credit and maybe take a haircut or two. And so that once that initial liquidity was dealt with, that market pretty much closed and dried up. And if I look at bond issuance, and I'm sure Robin's got some additional sectors, you can just see in terms of that bottom graph there, 2020 bond issuance by sector, how it's absolutely just fallen off the charts. And we see, as I mentioned earlier, fund managers are putting their cash into government bonds as opposed to anything else. The question that remains is, what the impact does this have on corporate bonds in South Africa, particularly the primary issuance? And as I mentioned before, primary issuance absolutely froze. So there was very little primary issuance, certainly none in a public auction space. We haven't had a public auction, which used to be our primary method of engaging with institutional investors in terms of capital raising, since the middle of March. March, April, May, June. What we've seen happen in June are select private placements and one or two book builds as we've seen the financial institutions come back to the market. Standard Bank did a very successful book build just the other day. Nedbank has done two in the last, I think, one on Friday and one today. But as soon as you de-risk it by engaging directly with the specific investors, you're in control of the situation and you've built up to that. So that primary issuance market, for all intents and purposes, is closed, and we're feeling the effects of it. And what you see is that borrowers who traditionally would have had to refinance themselves in the debt capital markets are now going to the banks. And they're saying to the banks, listen, we need to tap in here. And of course, the banks are saying, well, we've only got X amount of facilities before we get credit exposure limits get hit, et cetera, et cetera. So it becomes a huge challenge for those that have been, how can I say, regular users of the debt capital markets. I mean, there's even been cases more recently where companies that were, how can I say, that had strong balance sheets a year ago and would never have considered a rights issue, an equity rights issue, are now considering the possibility, depending on how COVID and lockdown impacts their businesses over the next 6 months. And we're talking about AA companies, blue chip in the South African context, that are unable to finance themselves in this market because of the uncertainty and the length of how can I say this malaise that is the lockdown has caused.
So if I can just ask, it's not the case necessarily that private placement might become the new vehicle for issuance, taking over from the auction process. Private placement, has that just been a sort of a desperation method, really?
I don't think it's going to take over. I mean, auctions were our primary methodology of price discovery, right? And it's such a critical part of our markets when we don't have, everyone's kind of one-way thinking in this country, and so we don't have a lot of natural opportunities for price discovery. So primary issuance, has been a really strong supporter and provider of benchmarking pricing, along with what the banks have done in their NCD curves, along with what the government's done in its government yield curves and treasury bills. So I think down the line, I think we will revert to public auctions again once we are firmly settled in our new normal. But for now, it's like risk off, and as soon as it's risk off, we're into private placements and sort of multi-day book builds to kind of achieve the same sort of capital raise.
Right.
I don't know if you, maybe just to give you a sense in terms of primary issuance of what's happened, I've just taken a snapshot of some of the DCM issuance during the South African lockdown, and interrupt me if you have any questions, but just some names there. And if you just cast your eyes down the right-hand side, you can see how the spreads have moved out. The credit spreads have moved out anything from 75 to 100 basis points, and in some cases more, depending what the nature and the term of the actual underlying issue is. Certainly we've seen those spreads move out, but that, as I mentioned earlier, hasn't compensated for the drop in JIBAR by over 200 basis points. It's been really a challenging time, I think, for the majority of corporate South Africa, in terms of the fact that this market has essentially closed and they've come to rely on it. Perfectly good credits have just been unable to raise the capital that they were looking to raise.
Wow, that's it's pretty sobering, really. And what about in the secondary markets, Robin? Just turning to you for a moment, because obviously there's going to be a knock-on effect on the secondary market. So, how has the behaviour and health of the secondary markets been in terms of trading volumes and liquidity and spread dislocation? I mean, what's driving everything on the secondary markets?
Yes, absolutely. So we've seen a significant impact in the secondary market. I'm going to share some slides with you now. So as Bruce mentioned, investors began to scramble for liquidity in mid-March as government bond yields rose and they had to meet margin calls, some of the more leveraged investors. And they sold their most liquid investments, which were bank bonds, listed bank bonds, and NCDs as well, which are negotiable certificates of deposit. They tend to be more liquid than other instruments, as banks are obliged to make a two-way market in these instruments. And bank bonds are also relatively more liquid than other listed bonds, as many of the large banks make a market in these too. So as you can see in this graph, we typically see trading volumes of just over R500 million a day in the secondary market. But in the middle of March, those rose considerably, and we saw 6-7 times as much trading as we usually see. We did see increased trading in subordinated bank paper, possibly some risk aversion by some investors, but most of this increase in trading activity was driven by senior bank bonds, which you can see here. Senior bank spreads began to widen as a result across all tenors. But what is interesting about this chart is that we've seen some compression in spreads now in May, and this continued into June. And this is likely due to the compression that we've seen in NCD spreads, as well as the liquidity situation normalized. So you can see these are NCD spreads here. Significant impact at the end of March as investors sold these back in large volumes to the banks, and banks increased their bid offer spreads to protect their own liquidity. We then saw the Reserve Bank stepping in, assisting the banks by introducing intraday and weekly additional repo auctions, increasing the term of repos. They allowed a reduced liquidity coverage ratio, which assisted the banks. And so the situation normalized. And we've now seen some recovery in spreads, and even for 12-month NCDs, those spreads almost back to where we were pre-COVID. And this is significant for the rest of the market because senior bank spreads tend to price off the more liquid NCD curve. And then we see corporate bonds and the less liquid listed bonds pricing with reference to senior bank bonds. For the market as a whole, trading volumes stabilized in May. So we typically see an average of about 10 billion turnover in the market on a monthly basis. And so that spike that we saw in March remained elevated in April, but has now stabilized into May. If we look at the broader impact on spreads, we have seen spread widening across most of the market. Spreads began to widen in March in a number of sectors. You can see here bank additional tier 1 paper and also subordinated tier 2 paper. For the insurers, etc., we saw that widening, and that accelerated then into April as well. A lot of this is based off of trades, but then also offers on broker screens. So because our market is still fairly illiquid, the stock exchange considers on-screen offers as part of its valuation methodology if we haven't seen any trades in a bond. So investors looking to offload less liquid bonds would have to offer them on a broker screen and wait for a buyer, and the JSE takes that pricing into account. And that resulted in considerable spread widening for a lot of these sectors. At one stage, our secondary market was almost entirely offered with no buyers, but we've since seen some stabilization. Big bids are beginning to come through, and sellers are now finding some buyers. And that has resulted in the retracing of spreads in some sectors like additional tier 1. You can see here into May, some of those spreads compressing a little bit. In terms of the SOEs, Bruce earlier mentioned Land Bank. So the Land and Agricultural Development Bank is a state-owned development finance institution. They experienced liquidity issues in April and defaulted on some of their debt, which triggered cross-default clauses on their listed bonds. And so investors began offering those vigorously on broker screens, and we saw those spreads widening considerably in April and into May. And that's had some contagion effect on other DFIs in the market. Investors now are weary of the level of implicit government support that is factored in there. Even the rating agencies, Moody's, has now reduced the ratings uplift that some of the other DFIs receive from implicit state support. So that has had an impact there. This graph shows the same thing along a time series, and you can really see the huge impact at the end of March and some stabilization in a lot of spreads since. DFIs, that's the land bank default there. But for other sectors, non-property corporates, we're still seeing these spreads trend wider in May and into June as well. And so sellers and buyers aren't meeting in the middle there yet. We could see some more spread widening still. Coming back to the banks, we have seen some compression in senior bank spreads, as I mentioned. Spreads on tier 2 paper have remained more stable since spiking at the end of March. We recently conducted a survey. We had responses from 27 of the large asset managers in the country on where pricing should be at the moment in the primary market. For 3 years senior bank pricing, most respondents thought that pricing should be between 140 and 150 basis points. And this implies a pickup of about 30 to 60 basis points over similar term NCDs. So historically, that pickup's been around 21 basis points. It did reach as high as 37 after President Zuma fired our finance minister at the time, at the end of 2015, and we saw significant risk off in our market then. So you can see that it's not quite business as usual yet. The market is still pricing in quite a big liquidity premium for senior bonds over more liquid NCDs. For 5-year paper, The market expecting pricing to be between 170 and 180 basis points for senior bank paper. And again, that's implying a pickup of 35 to 65 over similar term NCDs, which is significant. For subordinated bank paper, most respondents thought that a 10 no-call 5 Tier 2 bond should price around 350 to 375 basis points. That is very much in line with what we're seeing in the secondary market. So here, this is looking at highest secondary market spreads, about 176 for senior 5-year paper, 382 for Tier 2, 600 for additional Tier 1. You can see that the spread ratio of subordinated paper to senior paper is now high again, similar to what it was after the finance minister was fired in 2015, when we saw a lot of risk off in the market. And I think what is interesting as well is most investors expect there to be a second round of spread widening. So I think when we see increased bank provisions coming through, a lot of the banks have half-year end now at the end of June. And as we know, IFRS 9 is forward-looking, so I think we could see credit impairments spiking a lot earlier than they did during the global financial crisis. The banks also offered 3-month payment holidays to a lot of customers in recognition of the difficulties that lockdown has resulted in for many clients, and those need to start performing again in July. So the banks are going to need to take a view what percentage of those are likely to perform, and they're likely to be quite prudent. So I think the market is expecting that may have a second round impact of spread weakness. And as Bruce mentioned earlier, we haven't yet seen the peak of COVID in South Africa. That likely still to come in August, September. And so we could see more risk off as a result of that. And largely for additional Tier 1 bank paper, expectations for primary market between 600 and 650 basis points, very similar to what we're seeing in the secondary market. So the secondary market, a good bellwether there for primary market appetite. And you can see these spreads are back to where we were when the additional Tier 1 market really kicked off in South Africa. And previously, we haven't seen much spread differentiation between the strongest and weakest issuers in the market. But interesting to see that most investors now expect there to be some spread differentiation to factor in credit quality of the various issuers and their capital buffers.
Thank you, Robin. It's very comprehensive data there. Thanks for that. Just going back to, you've talked a lot about bank paper, etc. So do you think that the banks generally have been sufficiently capitalized and any kind of central bank measures have been adequate in order to be able to shore up the economy?
I think the moves by the South African Bank or the South African Reserve Bank and to ease up on capital restrictions has certainly played a significant role. I think it's put probably about 500 billion rands worth of extra space and breathing space into this market, which is significant. And I think the banks they have been well capitalized. We are very rigid in how we have been disciplined in following the Basel requirements, and I think the world at large knows that our central bank and National Treasury are probably some of the most attentive to detail and kind of market leaders in following global best practice when it comes to that sort of thing. So that has certainly stood us in good stead. I am a little bit concerned about ratings-wise going forward. And I mean, the point is, yeah, we've got some big milestones coming up ahead of us. We rely right now on Moody's. And the bottom line is we've got a medium-term budget speech coming up in October, which I think is going to be a critical point in terms of how the rating agencies review us. Because by all accounts, I mean, our debt burden and our affordability metrics are below BB. So, that does not augur well for the future. So we need to understand what that really means. I mean, government's ability to mitigate the above risks, like I said, are limited. And while monetary policy cannot address the structural economic issues, I think we're going to have some real challenges in terms of dealing with the same issues we had before COVID arrived, and how to stimulate the economy in a period of low and global domestic growth, and so manage the political will that's got to be that's required to actually implement something like this. So it's going to be a challenge for us. Make no mistake.
And Bruce, just sticking with you for a moment, let's have a chat about investor sentiment. I know we've talked a little bit about in the primary and the secondary investment behaviours, but how do you think investor sentiment has been during the pandemic, and you know, what do you think is what do you think the near-term prognosis for the investors and the investment community generally in South Africa is going to be like? And you've already highlighted some of the difficulties with the economy in the near term and in the long term, but are investors helping? Are investors going to be part of the solution?
Listen, I think from the outset, they were all very aware that we are all part of the same movie, right? And so everyone has got to step up to the plate in some shape or form. But whilst there are governance issues and whilst there are credit issues, they would kindly steer away from the related credits, recognizing the fact that borrowers have become dependent on them to some extent. And so the initial response was, yes, we'll lend you smaller amounts for shorter terms and the pricing will increase to reflect the additional risk. Right now, they've got no idea what that additional risk looks like because COVID is still very much here and it changes every time you open your eyes. So in that scenario, there's a standoff, and investors, I think, are itching to get back. There's been some good opportunity if you are gutsy enough in the secondary market to go and pick up some really, really nice spreads, because everyone's trying to mitigate their exposure and their risks. And even some of the banks are kind of like trying to protect their portfolios and selling down overexposure in certain areas, even if that means at a loss. So if you're a smart investor and you've got some dry cash and capital set aside for this, there's some great opportunities. But for the majority, I think it's retreat to a very conservative space, and watch from a distance for the market to resume. Because don't forget, a lot of these fund managers have got to report back to their trustees, and it's so easy to get hammered. And they've just come out of probably 2 years of getting thoroughly bashed by their trustees for investments in all sorts of things, SOE and governance related, where they weren't, how can one say, I mean, they didn't ask enough questions or they didn't ask the right questions. So there's a particular increase in the attention that investors are paying to the credit quality of corporates, particularly borrowers, that are tapping the debt capital markets. And you'll find that they are delving substantially deeper into the credit metrics of those that are wanting to raise capital than they ever have before. And I suppose in some senses it's a kind of a maturing of the market from an investor's perspective. And the big houses have the resources to deal with that. The little houses kind of follow suit. And there are no real clear guidelines if you don't have your own in-depth credit teams to give you a steer of what's good and what's bad and what's right. So in that case, they'll just remove themselves. So it does talk about, is this a time for a switch in asset allocation? I think not, because I think equities are equally as volatile as what the fixed income world would be, and certainly carry a far greater risk profile than what the debt does. So investor sentiment, I sense that they're itching to get back in this market, but they're just not allowed to. And I don't think that it's going to happen in any shape or form on a significant scale in the next 3 months, not until we've peaked in terms of COVID and understand better the economic implications of what might even be a return to lockdown 4. Unlikely, but yeah, it's a possibility. And
Robin, do you have any views to add to this?
It is obviously a very fluid situation at the moment. Investors, they're putting a premium on liquidity, given the liquidity crunch that we saw in March. As I mentioned, many expect there to be a second round of widening, so that may deter meaningful appetite for credit in the short term. And it will be interesting to see, the impact on some of the AAA rated names that we have in our market who have in the past priced below where the banks price. And that paper is a lot less liquid than bank paper. So will they be able to price as tightly going forward as investors value liquidity more than they have before? So it'll be interesting to see that dynamic unfolding in our market.
I think just to add to what Robin's saying, Katie, we've seen investors, generally speaking, because we've had this dichotomy between the bank market and the debt capital markets. Now, historically and globally, you've got a debt capital markets that is it's more like a generic commoditized structure with terms and conditions that are vanilla that allows it to trade, right? As against the bespoke bilateral terms of a loan, for example. But what's come to the fore, particularly in the property market in South Africa, is that historically banks have taken all the security, have got heavy covenants in there, and the property sector, property counters that go and want to tap the bond market, invariably it's unsecured, and there are much lighter T's and C's that are incorporated in the bond documentation. So there's a couple of working parties that are, and we've had a CISA which represents the investors, BASA representing the banks, and representatives from the REITs themselves getting together to understand how best to manage this. Because what we've seen is that a property company that's had a 700 million rand bond maturing couldn't refinance it in the debt capital markets, so they go to the banks. And the bank says, okay, well, I'll do it, but I'll do it only on security. Thank you. That's the way we've always operated. So there's a lot of discussion around that, and it talks to my point earlier on, just about getting there's a pressing, need from investors to be seen and have rights that are pari passu to what the banks are having. But there's also a recognition that these are different markets. The one is a tradable exchange-based market, and the other one is a bilateral loan market. And nowhere in the world do those two tie up. Yet in South Africa, there's this unheard, unspoken pressure to drive the two together, which doesn't serve the purpose of a fully functioning debt capital market, so to speak.
Right, but it does require a little bit of flexibility and pragmatism from the investor community, I guess, in order to be able to, keep funding the economy and the issuers' requirements. Pardon?
No, absolutely, and I mean, I think they would like to participate in that. They just want to have an equal say at the table, in terms of protection and investors' rights and so on.
And in terms of flexibility, that kind of leads me on to the next point that I wanted to ask you, which is about, how are the markets adapting to the current pressures? So, of course, we all have had to make significant adaptations in our functionality, in our working life, etc. And for most of us, I think we're all still in this situation. But I was just kind of wondering, in the face of these sort of conditions and all the adversity that they bring about, have the markets in South Africa had to innovate to adapt to the new conditions, for instance, by using more fintech solutions or by, looking towards sustainability a little bit more, maybe the issuance? I know you said issuance is not a big, it has not been healthy, but might this lead towards, looking at sustainable instruments, COVID-19 or social impact type transactions? I mean, where do you see this coming out? I'll ask this one of Bruce first, if you wouldn't mind.
No problem. Thanks, Katie. So, yeah, I think innovation is certainly going to be one of the keys that are going to open up some new doors here. And in terms of market innovation, I think investors are beginning to shift towards the whole world of sustainable finance. This was, it's been very evident in the developed markets for a number of years now. And it's been catching on slowly in the emerging markets, particularly in South Africa. And I think when we did our renewable energy green bonds last year as a bank, we issued just under 3 billion rands of those. The biggest challenge we had was to educate not only the investor community, but all market participants as to the value of why go green, why go social impact. And I think that awareness has been growing. And what we've seen was the introduction of COVID-19 has created a rocket under people's awareness across the spectrum, starting with their own personal health. And if you talk about personal health, then you talk about the health of the economy. And what does it mean to have a healthy economy and a healthy environment? And so the whole tag around health assumes a whole new level of awareness. And on the back of that, we've seen some nice innovations. 91, which is the Investec Asset Management, have launched a 10 billion rand fund targeting COVID-19 hit firms. The South African government is talking about green infrastructure bonds to facilitate capital spending and create employment, and never mind build up the infrastructure. Stanlib's launched a first impact investment fund as well. Sanlam's launched and has seeded 3 impact funds with just over, I think, 2.2 odd billion rand. So the world of sustainable finance, I think, is an innovative angle that has been given great impetus by the arrival of COVID-19, and I dare say that it's an impetus that had already established itself, and I think would have been here regardless, but it's been given a nice boost as a consequence. Just yeah, I mean, just as a first snapshot in terms of market innovation, and I think it's here to stay.
Good. And Robin, do you agree with Bruce's assessment?
Yes, absolutely. So there certainly seems to be more willingness and urgency for the private sector and the government to work together, which is positive. We've been waiting for a while now for private and public sector projects, partnerships to really take off. We've had a very successful renewable energy independent power producer program, and we've been really waiting for that to take off in other sectors of the market. So I think this may be the catalyst we need to see more of that happening in our economy. Certainly there is talk about potentially updating or amending Regulation 28 to allow pension funds to invest in these kind of infrastructure projects, which could be positive as well. And then also, you know, the move to a more virtual way of working. Our market certainly has been operating seamlessly as most of us have worked from home, you know, with conferences and roadshows, etc., now happening virtually. And so that has been positive as well. We certainly have had excellent engagements with our clients and haven't felt hindered at all by not being in the office. And I think it's been a positive experience for some issuers and investors as well, that life continues and those engagements have continued virtually.
Yeah.
Sorry, Katie, just to add to what you said earlier on, in terms of innovation. So what we've been able to identify is that there are developmental agencies around the world that if you can evidence a sustainable project or a sustainable cause, whether it's going to be an outcomes-based or an impact assessment or use of proceeds, is that there's significant global capital that can come at concessionary spreads. And we've seen that happening in South Africa, where we get global DFIs participating in domestic issuances, given that they are green or have sustainability or credentials supporting the Sustainable Development Goals, but certainly having an ESG flavor with the right sort of third opinion providers and second opinion providers, etc. And you can find that they would be willing to really, how can one say, support those initiatives at really attractive pricing. And more recently, we've completing a green tier 2 issue for Nedbank, which has also attracted significant interest. But it certainly is an innovative angle of looking at things, and it gives you a different lens and maybe a level of comfort that, because it's so transparent, you get a how can one say, a risk mitigation. Maybe not necessarily upfront a price differentiation, but a risk mitigation, which then makes your risk return profile that much more attractive if you have a sustainability angle applied to these borrowings. Great.
Well, that's very interesting. And just to sort of to highlight that in the UK, our Prime Minister here is stressing that, you know, in spite of the huge downturn in the economy that we've had, the way to get out of that is not to impose austerity as it would have been a few years ago, but it is to invest in infrastructure, particularly broadband, I think, in our country. And so hopefully that will be a positive consequence for developed countries as well as developing nations globally. You know, one of the positives to take away from the whole COVID-19 experience. And I guess that kind of leads me on to a wrap-up question for each of you. And Robin, maybe I'll start with you. What would be your key takeaways from the whole COVID-19 pandemic, and how do you think South Africa and the debt capital markets can kind of harness the experience for the good? I mean, what is the good to finally come out of this?
Yeah, well, I mean, the well-known saying goes, never waste a crisis. And I think from an economic policy point of view, it's positive now that we're seeing our National Treasury focusing on debt stabilization. This is a major departure in approach. The rating agencies seem to be a bit skeptical, but I think it is positive that we're at least focusing on that now, which hasn't been the case in the past. Politically, I think there's more room now to be firmer with some of the state-owned enterprises. We just don't have the luxury anymore of continuing the endless bailouts that we've seen, and politically, I think there is more space now to be firmer, which really is positive. In our credit market, it is still a very fluid situation, and as Bruce mentioned, there is a shift to government bonds, etc. So I think it's going to take a while for our market to get back on track. But it's certainly positive that so quickly we've seen a stabilization happening in the secondary market. More bids returning into the market, more buyers. So I think that is positive. But again, we keep an eye on the horizon to see what happens with the peak in COVID. And what impact that has on, second round impacts.
Very good, thank you. And Bruce, just to give you the last word.
Thank you, thanks, Katie. I think it's about looking through the fog to what's on the other side. And I like Robin's analogy, never let a good crisis go to waste. So I think there's some very valuable lessons that have been learnt out of this, particularly in South Africa from a social perspective. It's highlighted a lot of inequalities and divides that need to be addressed. It's highlighted where there's been underperformance from a governance point of view. So it's certainly shone the spotlight on a lot of places where people wouldn't really want to look. But having said that, it's painful, but you build up a resilience and you understand what needs to be fixed. And on the back of that, I think if we can at least have the political will to apply and implement some of the structural reform, I dare say that there is significant foreign capital, and we only need a drop of foreign capital to make a significant difference in this country in terms of where our interest rates are that are really attractive returns. Let us get back to a stable currency, and as many people as you ask, so you'll get opinions of where that might be in a year from now. But nevertheless, I think that there's better than even chance of us attracting a good proportion of foreign capital if we do the right things, and that will be a real bonus for South Africa Inc., so to speak.
Yeah.
And that's not to mention what I mentioned earlier on about the awareness created about personal health and environmental health and the link that goes with it.
Yes. I think there's probably quite a lot that we can all take away from the experience in terms of our own personal carbon footprints, as well as the fact that we've all been forced to just kind of take a moment and recalibrate ourselves and recalibrate our lifestyles and our professional choices as well. I'd love to thank both of you very much for participating in this webinar today. It's been really, really insightful. Thank you both very much.